All right. Welcome, everyone. So, today we are going to talk about Ind AS 2 inventories. Inventories is, one of the simplified standards, and we've been learning about how to value an inventory, and you know, the how do you account for inventory, and what's the reason why we need to have inventory in our financial statements, right, for a very long time, right from your foundation days, right, in a way, or from a graduation. So this is a subject I would say is fairly well covered, understood, and also when I look at for the at our level, I think this is fairly simple as a topic, right? And often also in practice also we don't experience too many challenges around inventory, but there are subtle issues, right, which we see is what one needs to be careful about is an area which one needs to understand better. And though inventory is a subject which is often prone to fraud, right, from a financial statement perspective, right? Because it is there in most of the companies having manufacturing operations, but or a lot of companies in services also, right? They do also have inventories, and it's an area open to fraud. But so it's a larger auditing issue actually. Okay, inventory verification is a huge auditing issue. But from an accounting perspective or from an accounting principle perspective, right, inventory is not that complex. And what we will do is we will go through all the concepts. We will understand this with the help of examples. We'll also, in a way, talk about some of the examination questions which have come in the past for you to have a fair understanding, right, as to about the what is it we're getting into, the topic, and how you need to prepare yourself for a deeper understanding of this topic. Okay, so from a need of the standard perspective, what are the key considerations? Okay, what is meant by inventory, right? And when you think about this, right, inventory is something which is to say that let's say you run a manufacturing operations, you run a services business, or a trading business, right? It is what you actually produce, right, that is being characterized as inventory, and or what is being used in the manufacturing process, right, that is being characterized as an inventory. And it has variety of forms, right? Raw material, work in progress, finished goods. If you're in trading, normally you're going to purchase finished goods, and you're going to sell, and whatever kind of thing you're trading, that in for your business purpose, that's the finished good, right? And if you are in services business, you do have a lot of spares and all, in a way. Let's say if you're in a providing paint services, right, and you already stock a lot of paint material as part of your business, right? That's an inventory from your business perspective. Okay, so we will understand this a little bit more. What is included in the cost of inventory? So what all goes into the cost of inventory, right? And why it is relevant is that what goes into your balance sheet, what goes into as a period cost, and what in a way gets factored as and when inventory is being sold, right? So important is to understand, and that's the heart of the standard, right? What all goes into the cost of this inventory. What are the cost formulas used for inventory evaluations, right? Different formulas, right? FIFO, standard costing, or retail method, LIFO, for example, okay, which is generally not permitted, okay. And then how do you deal with other weighted average cost, right? There are multiple, in a way, formulas which are being used for inventory valuation, and this is an area which we again experience some diversity in accounting practice. Okay, so it's important for you to understand. Ordinarily, within industry sector segment perspective, there should be consistency. But if there are inconsistency, we it can result into significant impact on your P&L for the period, right? If there are different inventory formulas being used, but a lot of these are acceptable practice, right? Whether you follow weighted average, whether you follow FIFO, all of these are standard acceptable practice of inventory valuation. How and when to perform write downs to net realizable value, right? So inventory in a way talks about cost or market price, whichever lower, right? The principle, accounting principle for inventory valuation is cost or market price, whichever is lower. So we'll try and understand what's the meaning of net realizable value, and when exactly we need to write it down, okay? How should inventory be presented in balance sheet, and what disclosures are required to be given? So how do we present this? It's a balance sheet item, right? It gets recorded, and then, if it is manufactured, sold during the year, or purchased or sold, it moves to the P&L. But if it is there at the end of the quarter or any reporting period end, it is to be presented in the balance sheet. In the P&L, it forms part of your cost of goods sold, right? It forms part of your cost of goods sold. So we'll look at some of the presentation and disclosure requirement, from a financial statement perspective. All right. So let's look at some of the examination trend, since May of 2015. And when we look at it, right, what do we see here? May 2015, 9 marks, right? But, for over last several, in a way, examination uh, trends, what we see is that the topic is losing its, in a way, importance, right? And it's just like 4 to 5 marks, is what we see, is what is in a way being covered. As I said, it's not a complex topic, so it's good for you anyway to kind of clear the concepts and the principle, and that should be good enough in a way for you to get these 4 to 5 marks if the inventory as a topic is being picked up. Why, to my mind, the relevance of this has come down? Because now we have far more topics, right? Like topics like financial instruments, topics like consolidation, topics, other topics, which are far more complex, where there's a lot many more principles, where examination, we would like to test in terms of the depth of the understanding. And that is why inventory, possibly losing a lot of relevance from an exam perspective, but still it is important. It's a very important topic. In a way, when it comes to the industry perspective, right? As I said, this is a very complex auditing topic, or a very important auditing topic. And as we commonly see, fraud, whether it's inventory valuation issue, inventory verification issue, whether the existence issue, right? Many times, inventory is just not there, but it's there, it's not there in the financial statement. All kinds of issue is what you see from a financial statement perspective. But from an accounting perspective, I think it's fairly okay to deal with. All right. So let's try and understand the objective and the scope. So same thing. We what we need to understand for every topic, right? What's the scope? What are the recognition principles? What are the measurement principles? And what are the disclosure in a way requirement? And what are the exceptions? Everywhere there are some exceptions, right, to the rules as well. So we're going to try and understand the objective and the scope, the recognition, the measurement, and disclosures. And if there are exceptions, we'll pick up those exceptions as well. Now, objective of the standard is to prescribe the accounting treatment for inventories. What all standard deals with, right? Determination of the cost of inventory and its subsequent recognition as an expense, including any write down to net realizable value, right? It also prescribes how do you deal with this. It also provides guidance on the technique for the measurement of cost, right? There are several scenarios in which you don't apply, for example, first in, first out method or a weighted average cost method. So what are those methods? You may apply standard costing method, or you may apply a retail method, right? This is commonly we see in a retail industry, right? Like of the likes of Shoppers Stop or a Big Bazaar, or those type of companies, they may follow a retail method, which is, let's say, the MRP, which is there in the system, which is 100 rupees, and what are the general markups you use for that category of product, right? And if that is 30%, the cost is 70. So instead of, because you deal with thousands and thousands of SKUs, you then try to do an approximation method to figure out your cost of purchase, right? From that perspective. Or you do a standard costing method. In a lot of manufacturing industry, we see standard costing method in a way being used. But end of the day, whatever formula you use, you try and approximate that to your actual cost. I think that's the overall guiding principle, is what companies are expected to follow. It also outlines acceptable methods of determining cost, including the specific identification method, or a first in, first out method, or a weighted average cost method, right? These are different cost formulas in a way which are being allowed to be used. LIFO is not allowed. Okay, last in, first out as a method is not allowed as a valuation methodology, right? Remember this. Okay, LIFO is not allowed. Okay, LIFO, which is last in, first out, is not allowed. First in, the whatever you purchased and that has been sold first, that's the principle, right? Even though you may have hundreds of you may have made lots of purchases, lot of sales, right? And purchase at different price points. So all of that, all in all, you got to keep a track, right? Based on invoice wise details, and that's how you can possibly apply the first in, first out method, and the weighted average cost method, or a specific identification method. All right. So what all it talks about? It talks about the how do you determine the cost of inventory and the subsequent recognition and the measurement, right? And then it provides guidance, whether you can apply standard costing or a retail method, right? And it's also various valuation techniques, right? Which is your standard, which is your FIFO, first in, first out, your specific identification method, or your weighted average cost method. All of them are also in a way provided guidance. Okay. Let's talk about the scope, right? Remember, if something is covered specifically in any other standard, you go to that standard. Otherwise, we come to this standard. Okay. So Ind AS 2 should be applied to all inventories except, right? Except financial instruments, right? Financial instruments which are covered under Ind AS 109 and Ind AS 32. Okay. Biological assets which are covered under Ind AS 41. If there are biological assets, they are covered under Ind AS 41. Then you will apply Ind AS 41. The standard does not apply. Okay, does not apply to the measurement of inventories held by, again, producers of agricultural and forest product, agricultural produce after harvest, and mineral products, to the extent they are measured at net realizable value. Now, this is an important, in a way, exception. Commodity broker traders, and that's where we often see in an experience also. There's some mistakes we do see. If you're a commodity broker trader, okay, you are required to measure that inventory at fair value less cost to sell. Okay, that means you got to always do it at mark to market, fair value less cost to sell, in a way net realizable value. You got to keep it at mark to market. Commodity broker trader. Okay, commodity broker trader. Okay, commodity broker traders who measure the inventories at fair value less cost to sell. Okay, and hence you don't get the benefit of doing inventory valuation at cost or market price, whichever is lower. Their case, they measure the inventory at fair value less cost to sell, which is net realizable value. Remember that. Okay. So what are the exceptions? Financial instruments, biological assets, farmer producers, and commodity broker trader. Okay, these are in a way are exceptions to the rule, or to the standard. Okay, let's look at the definition. Okay, so what's the definition of what are inventories? Okay, they're assets in the form of material or supplies to be consumed in the production process or rendering of services, right? Which is raw material, right? They are either raw material, or for example, aluminum, steel in the making of car, crude oil held by refineries, right? So raw material which you use in your production process, and then in a way convert them into finished goods. Okay, in the process of production for such sale, okay, which is called work in progress. So inventory could be a raw material, it could be a work in progress, a partial completed ship meant for sale by the company. That's an example of work in progress. Or it could be, let's say, a car which is still in the making. That could be another example. Held for sale in the ordinary course of business, which is a finished goods. Okay, finished goods. Example, goods held by retailer or distributors. Car which is ready for sale by manufacturing companies. So in a way, there are three types, right? Raw material, work in progress, or finished good. That's what we see across the board. Companies, manufacturing companies, mostly in a way, making disclosures of the inventory type between raw material, work in progress, and finished goods. If you are generally a trader, right, you will have finished goods. If you for that, you kind of buy and sell finished goods. You don't in a way buy and sell raw material. If your business is only buying and selling raw material, I mean, that becomes a finished goods, right, from your own business environment perspective. Okay, so these are different types of inventories, right? Inventories are an asset class. Okay, how do you measure them, right? How do you measure initial measurement of inventory? So inventories are measured at cost, right? Initial measurement of inventory is always at cost. Cost, right? Now, what all goes into as part of cost? Now, that's an important understanding, okay? And we will talk about that. What all goes into what is the meaning of this cost? Okay, let's just try and understand that. All right. So, what all goes inside the cost? Cost includes all cost involved in bringing the inventories to their present location and condition. Remember the accounting with the way we do for fixed assets? It's very similar, right? The whatever goes into your asset capitalization is that cost which you've incurred to bring that asset to its present condition and location. Similarly, inventories to their present location and conditions, right? All the cost which you incurred to bring the inventories to their present location and conditions. And then cost could be in various buckets, so to say. It could be purchase cost, and then it could be your cost of conversion, and then it could be your other cost. Okay, now what all goes into your purchase cost? Okay, now it is which is the purchase price, invoice value. This is the price at which someone has offered to sell, or you agreed to in a way buy. Import duties or non-refundable taxes. Remember, import duties, non-refundable taxes. If this is like a tax which is to be input or output, then you don't in a way load it to the cost of the inventory. Then you kept it into a separate account. But if these are non-refundable taxes, so whatever is incurred, that's the cost of the purchase of that asset. Transport handling charges, that also, so transportation cost, right, that also goes into inventory. If you received any discount, right, remember revenue, if you offer a discount, you will reduce it from revenue, right? Similarly, from an inventory perspective, if you have received a discount, that also you have to reduce from the cost of inventory. If you received a discount, that's not an income, okay? That has to be reduced from the cost of the purchase itself, right? And other costs which are directly attributable to the purchase, okay, could be, let's say, let's say you're paying toll charges, right, while the goods are in the motion. Okay, that's also is a purchase cost from that perspective. Then conversion cost, right? Once the goods been purchased, let's say now you're processing them, then a production cost such as direct material, labor, and other direct cost, and there could be overhead allocation, right? Fixed and variable production overheads. All of them are part of your conversion cost. Okay, so your purchase cost, your conversion cost, and there could be some other cost, right? Only if incurred in bringing inventory to its present location and condition, like non-production overheads. Could be borrowing cost in limited circumstances. Okay, borrowing cost in limited circumstances. Remember, for that, it has to be a qualifying inventory, like you have a qualifying asset. For a borrowing cost to be classified, to be capitalized as part of inventory, then it also has to be a qualifying inventory. All right, in a way, inventory which takes long period of time, to, in a way, manufacture, or, we see some of these, let's say, in the context of, beverage industry, right? Liquor industry, where you need to store your material, for a long period of time before they come to market. Okay, and that's where you may have the ability to capitalize some of the interest cost. Okay, we'll try and understand some of this with the help of examples as well. So what all goes as part of inventory cost? Cost is your purchase cost, conversion cost, and if there are other type of costs which are directly attributable in a way to bring the inventory to its present condition and location, and also in times could include borrowing cost. All right, let's deal with this example. Okay, Alpha Limited purchases car, right, from several countries and sells them to Middle East countries. Now, during the current year, Alpha Limited has incurred the following expenses: trade discount on purchase, handling costs related to imports, salaries of accounting department, sales commission paid to sales agent, after sales warranty cost, import duties, cost of purchases based on supplier invoices, freight expenses, insurance of purchases, brokerage commission paid to indenting agents, right? Now, evaluate. That's a question. Evaluate which costs are allowed by Ind AS 2 for inclusion in the cost of inventory in the books of Alpha Limited. Now, trade discount on purchase, yes, right? This is to be in a way part of purchase cost, right? To be reduced from the cost of purchase. Okay, handling cost related to imports, yes, right? This is also allowed, directly attributable cost, right? From purchase cost itself. Okay, salaries of accounting department, it doesn't sound like it relate to inventory, right? So it's not. Sales commission paid to sales agent, right? That's a sales process, not a purchase process. Okay, so not included. After sales warranty cost, nothing to do with the inventory, right? Not included, right? Import duties, yes, I have to pay import duty to purchase this, to be included, yes. Cost of purchases, yeah, directly it has to be included. Freight, yes, freight I have to include, right? Insurance of purchases, right? So I want to protect, right, my purchase, so that is also included. Right now, brokerage commission paid to indenting agents, right, that also is allowed. So when you look at all of this, other than salaries, sales commission, and after sales, everything is allowed. Okay, as to be part. These three type of costs are not in this example. There could be many, okay, which are allowed or which are not allowed, right? So you got to the principle is that, is this cost which is necessary to be incurred to bring the inventory to its present condition and location? If the answer to that is yes, then are these incremental costs? If the answer to that is yes, then you need to consider them as part of the cost of the inventory. If the answer to that is no, then ordinarily they will not be considered as part of the cost of the inventory. All right. Let's talk about deferred settlement, right? In a way to say that if you're purchasing something, right, and you get a extended credit period, right? So we talked about if you're selling something and if you're giving extended credit period to your customer, in a way, then you got to reduce from the sales price and record a finance income. Is the same principle, okay? That if you are buying something and as an inventory, right, which is raw material, work in progress, or finished goods, right? If you're buying something as an inventory, and if you're getting an extended credit from your supplier, then the expectation here is that you're supposed to reduce. You're supposed to what? Reduce. You're supposed to reduce your cost of purchase itself and record that as a financing cost. Record that as a financing cost. It's an interest cost. Okay. Now that interest also is like an interest which is there available to you under Ind AS 23. Okay. If you have a qualifying asset, you can possibly cover that interest also for the purpose of capitalization. Okay. If you have a qualifying asset, right? If you don't, anyway, that gets recorded as part of the period cost. All right. So let's look at it. Again, we try and understand the concept, and we'll try and pick it up with few examples, right? So if inventories are purchased on deferred settlement terms, I hope you understood, right? That means that say, I have, I'll have to, I purchase this today, which is, let's say, 1st of January, and I'm going to settle it after 30th September, whereas the normal credit period is 2 months. Okay. So you got a 9-month credit period, right? It's a significant amount of credit period which you've got, which is a deferred credit period. Okay. Purchase price for how do you account for then this? You got to look at purchase price for normal credit term will be the cost price equal to present value of all future payments and interest equals to deferred settlement amount future payment minus the present value of future payment. Okay. Recognize the difference as interest cost. Recognize the difference as what? Interest cost over the period of financing. Simple, right? So let's deal with this with the help of an example. Okay. Good Luck Limited, an electronic devices dealer, has purchased 1,000 high resolution cameras on a deferred payment basis at INR 5,000 per month. Okay, 1,000 high resolution cameras on a deferred payment basis at INR 5,000 per month. Okay, awesome. That means how much I'm going to pay? I'm going to pay for each camera. I'm going to pay 1,000. 1,000 cameras is what I'm buying. Okay, and I'm going to pay 5,000 per month. That means I'm going to pay into 12 is 60,000 per camera. All right. Now, if I were to do a cash down price for each camera, it is actually 50,000. That means I'm paying an interest of how much? Almost 10,000. At the end of year 20, okay, at the end of the year, 20 high resolution cameras remain unsold. Okay. 20 high resolution cameras remain unsold. So I purchased how many? 1,000. And how many are left? 20. That means you've done a good deal. 980. You've been able to sell. All right. Evaluate which costs are allowed by Ind AS 2 for inclusion in the cost of inventory in the books of Good Luck Limited. All right. So the question here is that what is the cost, of your purchase, what you need to carry forward, right? For how many cameras which are left in stock? 20, right? Inventory is required to be valued at cost or market price, whichever is lower. Now we don't have here the information about the market price. Any financing element shall be ignored for the computation of cost. Cash price per camera is 50,000. So I'm going to look at closing inventory at 50,000 into 20 is 10 lakh rupees. That's the cost of the closing inventory, right? That's important for you to understand. And whatever is the excess which I paid, that is nothing but an interest cost, or I have to pay. And we're going to compute the interest cost, and we'll try and understand this with the help of an example. Okay, let's take another example. Shadow Limited has purchased inventory at INR 6 lakh. Okay, on 1st of April 2016 on 2 years credit. They are 2 years credit. Okay, rate of interest for similar transaction is 10%. Rate of interest for similar transaction is 10%. Now you are required to calculate cost price of inventory and pass the general entries at the time of purchase and up to the date of payment. Okay. Now Shadow Limited has purchased inventory at INR 6 lakhs on 1st of April 2016 on 2 years credit. Okay. Rate of interest is 10%. All right. You are required to calculate the cost price of inventory and pass the journal entry at the time of purchase. It's always good to read the question twice, right? If it sounds very simple, okay, just read it twice. Okay. Now, it looks to me a simple question. Okay, let's look at the solution. I'm going to compute the interest cost. Okay, so on day zero, remember the principle. So what is it if you have purchased it at present value, right? So I have to pay 6 lakh rupees and then normal discounting rate is 10%. So I'm going to discount it, right? So if I'm going to discount it 6 lakh rupees at the rate of 10% for 2 years, I'm going to get 4,95,868. That's my cost of purchase of inventory. Okay. Now, I'm going to then compute interest cost for, this is a 2-year credit, right? So I'm going to compute interest cost for 16-17 using again effective interest rate method on 495 at the rate of 10%. 49,000 is my interest cost for the year 16-17, and for 17-18, what is my interest cost? 54,545. So I get to actually 6 lakh rupees, which I need to pay at the end of the second year. So my interest cost in year 1 is 49,000. My interest cost in year 2 is 54,545. This is not a straight line method of accounting. Okay. Remember, interest you always compute with reference to outstanding principal, right? And outstanding principal at the beginning of this contract is actually 4,95,868. Since I have not made any payment at the end of the year, that balance has gone up to 5,45,455 after accreting the interest cost for 1 year, which is 49,587 at the rate of 10%, which is the information provided in the question itself. Okay. Then I compute the interest for the second year as 54,545. So I get to 6 lakh, which is what I need to pay. And now we're going to look at some of the journal entries which I need to record. Now, as on 1st of April, I have a purchase account to creditor account, which is 4,95,868. And then I'm going to look at the end of the year, 31st of March 2017, I'm going to record the interest cost for that period, which is 49,587, and I'm going to credit to the creditor. And then I'm going to look at on March 18, interest expense account debit to creditors account, which is 54,545 in a way, and then you pay out to the bank, which is 6 lakh rupees debit and 6 lakh rupees credit. Okay. Credit account debit by 6 lakh and pay, and bank is in a way credit by 6 lakh rupees. Okay. Being payment made to the creditor. All right. I hope this interest accounting is fairly simple, right? You got to remember the effective interest rate method, and you also got to remember that if there are deferred payment terms, that interest cost needs to be knocked off from the cost of the inventory. It's important, right? That is not the purchase cost of inventory. So I need to reduce the invoice value by the interest amount, even though it's not called interest in the invoice. Okay. Even the invoice is for 6 lakh rupees, I have to take out the interest which is embedded in this invoice and record that as interest cost. All right. Okay. Let's now talk about, so we talked about the purchase cost. Let's now talk about the conversion cost. Okay, what are the conversion cost? Systematic allocation of fixed and variable production overheads. Okay, variable and fixed production overheads. What are my fixed production overheads? Indirect cost of production that remain relatively constant regardless of the volume. So if let's say it's a factory building, right? If you pay rent, right, or for the factory, that's the cost rent of the building, right? Which is whether you produce 100 units or 1,000 units, it will go to be the same, right? That is a fixed factory overhead. Okay. Now, example or depreciation and maintenance of factory building and equipment and right of use assets. So depreciation also in a way stays unless you use a unit of production method for depreciation, right? If you are normally using a straight line method of depreciation, that will again remain constant. Now, allocation of fixed production overhead is done based on normal production capacity. Now, that is important. Is done based on normal production capacity. Okay. Now, if you exceed your production against the normal, then you do it on actuals. Okay. So it's again follow the principle of conservatism, right? But if your production is lower than your normal production capacity, then you will not load, more than what is otherwise is required based on normal production capacity. Okay, and we will try and understand this with the help of an example. Okay, this is a very important concept. Okay, now normal capacity is the production expected to be achieved on average over a number of period or seasons under normal circumstances, taking into account the loss of capacity resulting from planned maintenance. Okay, that also is factored in. The actual level of production may be used if it approximates normal capacity. Let's talk some more. Allocation of fixed and variable production overhead when production levels are abnormally low. Unallocated overheads are recognized as an expense. They are not allowed to be charged to inventory. Unallocated overheads are recognized as an expense in the period in which they are incurred. In periods of abnormally high production, the amount of fixed overhead allocated to each unit of production is decreased. Okay, is decreased so that inventories are not measured above cost, right? That's the basic principle. You can't go below cost. You can't go, so you got to measure it at cost. Okay, how do you determine cost is what you need to figure out. Okay, and what we're trying to say that if there's a purchase cost, that anyway is directly attributable, directly identifiable, no problem, right? But the conversion cost, and there are factory overheads, then you need to allocate those overheads based on normal production capacity, right? And if there are abnormal wastage, plant is shut down, does not mean that I'll continue to allocate that cost to my inventory, even though there is no inventory is being produced, and or the inventory which is produced, which is much lower than the capacity, I can't allocate the excess overhead, which is not being absorbed, right? But if I've done more production, right? Now, if you've done more production, then you just can't say I will still allocate based on standard cost. Okay, then you can't allocate more than your actual cost. Okay, and again, as I said, we will try and understand this with the help of an example. Now, when it comes to variable production overhead, it's much simpler. Okay, variable production overhead normally vary with per unit of output, so to say, right? Indirect cost of production that vary directly or near directly with the volume of production, indirect material, indirect labor, all of them in a way gets allocated to each unit of production on the basis of the actual use of the production facility. All right. So let's do a case study, which is again adapted from your May 2018 examination. So Kudos Limited has a plant T with the normal capacity to produce 50,000 unit of a product per annum, 50,000 unit of product per annum. And the expected fixed overhead is INR 1,50,000. Expected fixed overhead is INR 1,50,000. Okay. Now, fixed overhead on the basis of normal capacity is INR 3 per unit. Okay, fixed overhead on the basis of normal capacity is INR 3 per unit. Okay, simple. Now, determine the amount of overhead to be included in cost of inventory. Determine the amount of overhead to be included in the cost of inventory. There are three different scenarios. Okay, case one, when the actual production is 50,000 units. Case 2, when the actual production is 37,500 units. And case 3, when the actual production is 7,500 units. So we are talking about three different scenarios, but the cost is same. And the normal capacity is 50,000 unit, and my fixed production overhead, fixed overhead for this capacity is 1,50,000. So the question is, how much is the amount overhead? So if it is 50,000 unit, 50,000, of course, then 3 rupees, right? Per unit I'm going to add. Now, if it is 37,500, I'm going to still allocate 3 rupees, and the balance is actually going to be expensed off. Okay. So if I were to allocate on 37,500 into 3 rupees, how much I'm going to get, right? Which is 1,22,500, right? If I am right. And no, 1,12,500. Sorry, I'm not right all the time. So 1,12,500, right? And if it is a 75,000 unit, then you're going to allocate how much at the rate of rupee 2 per unit, okay, which is still going to be 1,50,000. So in this case, nothing going to go to the PNL, nothing going to go to the PNL, but in this case, right, you will have a hit to the PNL of 37,500, right? Now let's look at the solution here. Actual production is 50,000 unit, fixed overhead on the basis of normal capacity, and actual overhead will lead to same figure of INR 1,50,000. Therefore, advisable to include this on normal capacity. Now, if the actual production is 37,500 unit, now the fixed overhead is not going to change with the change in output and will remain constant in INR 1,50,000. Therefore, overheads on actual basis is INR 4 per unit, and actually it gets to 4 per unit, but you are not supposed to do it on that basis. If I'm going to value at 4, it will be overvalued, and the losses of 37,500 will get absorbed in the balance sheet, which is not permitted. Okay, so therefore it is advisable to include the fixed overhead per unit on normal capacity to actual production, which is 37,500 into 3, INR 1,12,500, and balance INR 37,500 shall be transferred to profit and loss account. Now when I look at situation 3, when the actual production is 75,000 units, right? You've done very well, right? For the period, your normal production is 50,000. You really stretched your plant, but your fixed overhead stays at 1,50,000. Now they're not going to change with the change in output, and they'll remain constant at INR 1,50,000. Therefore, overheads on actual basis is INR 2, and that is what you will apply here, right? If I were to value inventory at 3 rupees, then I will end up overvaluing the inventory, okay? So my inventory valuation principle is cost or market price, whichever is lower. So total fixed overhead, if I were to apply 3, it comes to 2,25,000, whereas I've only incurred 1,50,000. Therefore, it is advisable to include fixed overheads here on actual basis. All right. Let's look at other cost example. What are the other cost here? Okay. Now, Lord PLC build aircrafts on a made to order basis on behalf of its customer. Okay. Now, Lord PLC borrows money from bank against the construction of aircrafts. On completion of construction, the aircraft is sold to the customer and money is received. It takes a substantial amount of time. For construction of the aircraft. Inventories that require a substantial period of time to bring them to a sellable condition are considered to be qualifying asset under Ind AS 23. Interest cost on such inventory is added to the cost of inventory and not charged to profit and loss account as a period cost. Okay. Now, the extent to which the borrowing cost is included in the cost of inventory is determined on the basis of the principles as stated in AS 23. All right. Awesome. Okay. So now we've talked about different types of cost which goes into your inventory capitalization or determination of cost, which we have talked about purchase cost, we talked about cost of conversion, and we've also talked about other cost. Okay, and when we talked about purchase cost, we picked it up with few examples, right? The cost of purchase or the handling cost, but not the cost of the accounting department, right? Though, what costs are eligible for capitalization and what costs which are not forming part of the inventory. Then we talked about the conversion cost, and lastly here we focused on the overheads, right? So if there's a cost of raw material, cost of anything which goes as part of the production process, all of that is allowed, right? Variable production overheads. But if there are indirect production overheads like factory depreciation or a rent, etc., then you determine the normal capacity, you determine the total cost divided by the normal capacity, you determine the cost per unit of output, and then you allocate that cost, all right, to the cost of inventory. And then we talked about these other costs like interest, right? And when do you need to allocate interest? You allocate interest when they take substantial period of time. We talked about another example when you're actually buying goods on credit. If you're buying goods on extended credit, then there is an interest cost which is embedded as part of the cost of purchase that you need to exclude. Let's talk about a few more costs, right? Which we need to exclude, right? And what are these? These are like abnormal amounts of wasted material, labor, anything which sounds like abnormal in nature. That's a period cost that you're not allowed to be in a way charged to inventory cost. Storage cost. Storage is also like a period cost unless, as I said, you're storing, let's say, liquor, right, which needs to be stored for a long period of time before it actually gets into its present condition and location, which can be consumed, right? Storage cost for a trading business, that's a period cost. This is not allowed to be charged to inventory, right? Storage cost unless necessary to the production process before a further production stage. Administrative overheads are that do not contribute to bringing inventories to their present location and conditions, such as security charges. All of them are excluded. And selling cost, right? That also is a period cost. Okay. Now, if there is a let's say cost which is necessary to bring the inventory, and that's where that's where we see some element of judgment. Okay, some element of judgment, and you got to be careful. Anything which is related to abnormal, it is period cost. Storage is a period cost unless you're doing it for the type of production process which requires storage for a long period of time, right? Before it gets into the production process or in the consumption process, right? Security, administrative overheads, right? You're paying, let's say, placed a goods on order for which you have to pay security deposit, all of that. These are period costs, right? So on and so forth. Selling cost like commission, all of these are not to be considered for your inventory cost. So let's look at some example. What specific overheads can be excluded or included, okay, in the cost of inventory? Now, inclusion of an overhead to the cost of inventory would require the function of the overhead as its specific attribute, right? If it is a function of production, selling, or administration. Now, general administrative and management overheads are not directly related to the production and therefore are excluded. So general administrative, like your cost of your head office, right? You can't charge the cost of the head office to the manufacturer, but if the cost of the plant management, right, that can be considered to be included in the manufacturing process, right? Because you need a plant supervisor, right, for you to continue with the production process, okay, so on and so forth. Now, production overhead, on the other hand, are related to the production and therefore included in the cost of inventory through an appropriate allocation basis. Okay, so the production overheads are included, whereas the general administrative overheads are not included. Okay, let's take an example. Now, the production of whiskey requires the aging of whiskey before the bottling process. So you got to, hold them, keep them, right, in cask, okay, for long duration. The value of whiskey to be sold depends on the aging and maturity. Now, can storage cost be included in the cost of inventory, right? The answer is yes. Storage cost is allowed to be added to the cost of inventory only if it is necessary in the production process. prior to a further production stage. In the given scenario, the storage cost that the entity incurs during the aging process should be included in the cost of inventory because aging is integral to making the finished product sellable, right? Aging is integral to the whole manufacturing process of liquor. All right. I hope this example is clear. Ordinarily, storage costs are expensed as incurred, but in this case, you are allowed to look at storage to be considered as part of the cost of inventory. Okay, let's move forward. So if you have incurred selling costs, right, as required by Ind AS 2, selling costs are generally excluded from the cost of inventory, and these costs are required to be recognized as an expense in the period in which these are incurred. Now the question is whether the distribution cost would be included in the cost of inventories under Ind AS 2, the distribution cost, right? Cost of distribution, to your warehouses possibly. Okay, so it's an interesting question. Okay, it's an interesting question to say that distribution to whom. Okay, cost of distribution or dispatch to an end user customer or a cost of dispatch to a warehouse for further storage, right? Can that be included or not? Okay. Now, when we look at the solution, now generally the selling and distribution costs are used as a single term because both are related to selling cost and are incurred to effect the sale. Now, distribution costs are usually incurred by the seller to complete a sale transaction by making the goods available to the buyer from the point of sale to the point at which the buyer takes the possession. As these costs are not related to bringing the goods to their present condition and location, the same are not included in the cost of inventory. Accordingly, though the word distribution cost is not specifically mentioned in Ind AS 2, these costs would continue to be excluded from the cost of inventory. Now, the only thing you need to remember here, if here the distribution is from the point of sale, right? However, if distribution is necessary, let's say you are doing a there is a plant at let's say at a location A. Okay, here I have the plant, and I'm going to have my warehouse at location B. Okay, here is I have my warehouse, not the customer. Okay, here I have the warehouse where there are a large number of customers. But the cost of dispatch. Okay. Here it's not a distribution, it's a cost of dispatch from manufacturing location to a warehouse location. Now this is allowed to be included in the cost of inventory. Okay, now from warehouse to end customer, right? Now if here you are doing from warehouse to customer, this cost is there, which is a distribution cost or a sales cost. The moment it is sales cost, then it is not allowed, right? Here it is not allowed. Okay, up till now this cost is allowed. Okay, this cost is allowed, but not the sales and distribution cost. Okay, remember. Okay, awesome. Let's quickly, in a way, summarize what we've talked about. Initial measurement at cost, which includes the cost of purchase, cost of conversion, and other costs. And we talked about what all goes into the purchase cost, which is a cash equivalent, import duties, transport cost, handling and other direct labor, and reduce the trade discounts, direct labor, material, overheads. All of that in a way goes as part of my conversion cost. And what all goes into my overhead other cost is like cost to bring the inventory to their present condition and location, and also the borrowing cost. And then we talked about a few other things like if you're buying on deferred credit, you got to exclude that, right? And we talked about abnormal cost, they need to be excluded. So we talked about cost which needs to be excluded, talked about the cost which needs to be included. We also talked about the thing is that sales and distribution, like, but if it is distribution from factory to the warehouse, that's not distribution. That's like bringing the inventory to its present condition and location. Anything which is direct, incremental, that is consists part of the cost of inventory. Other than that, it's a period cost or a sales cost which needs to be excluded or charged to the P&L, from that perspective. Okay, we will take a pause here. All right, thank you.